You're watching silver trade at $29 on your screen right now. In Shanghai, the same ounce is moving for $80. That's not a typo. That's not a glitch in the data feed. That's a $51 premium baked into physical delivery in the world's largest manufacturing economy. And if you think that's just an anomaly, a temporary dislocation, or some kind of arbitrage opportunity that smart traders will flatten out by next week, you've already misunderstood what's happening. This isn't a premium. This is a signal. And the signal is telling you that the paper price you're staring at has quietly decoupled from the metal itself. Let's establish something immediately. Silver trades in two worlds. There's the world of contracts, derivatives, futures, and exchange-traded funds where price discovery happens on screens in New York and London. Then there's the world of actual metal, bars in vaults, shipments on pallets, refineries running at capacity, and mints rationing allocations. For decades, these two worlds moved together. The paper price was assumed to reflect the physical price because arbitrage kept them linked. If paper silver hit $30 and physical was available at $28, traders would buy physical, sell paper, pocket the spread, and force convergence. That mechanism kept the system honest. But that mechanism requires one thing to function. It requires physical metal to actually be available at the paper price. And right now, in China, it's not. The Shanghai premium didn't appear overnight. It's been building quietly for months. It started at $5 over spot, then 10, then 20. Now it's 51. And here's what matters. That premium isn't moving because Chinese buyers are irrational. It's moving because they can't get metal any other way. The arbitrage that's supposed to flatten this premium, the trade that's supposed to be free money, isn't happening. Why? Because there's no metal to move. You can't arbitrage a shortage. You can't close a spread when one side of the trade doesn't exist in sufficient size. What you're seeing in Shanghai isn't speculation. It's desperation dressed up as price discovery. Now let's talk about why this is happening in China specifically. China is the world's largest consumer of silver. It's not even close. They use it for solar panels, electronics, 5G infrastructure, electric vehicle components, and industrial manufacturing at a scale that dwarfs every other nation. Their demand isn't discretionary. It's structural. It's embedded into their industrial policy. And here's the thing about structural demand. It doesn't stop when price goes up. It adjusts. It absorbs. It pays what it has to pay because the alternative is production shutdowns. And production shutdowns in China mean political instability. So when silver becomes scarce in Shanghai, the premium doesn't reflect speculation. It reflects necessity. They're not buying because they think the price will go up. They're buying because they need the metal to keep factories running. The metal isn't showing up at the price the West says it should. Here's where it gets interesting. The silver market is tiny. Annual global mine supply is around 850 million ounces. Total above-ground refined silver available for investment is estimated at maybe 3 billion ounces. Though nobody actually knows because so much of it is locked in jewelry, electronics, and inaccessible forms. For context, the gold market is 70 times larger by value. The oil market is 300 times larger. The global bond market is 200,000 times larger. Silver is a rounding error in the financial system, and that's exactly why this matters. It doesn't take much to move it. It doesn't take $1 trillion hedge fund. It doesn't take a sovereign wealth fund rebalancing. All it takes is a sustained mismatch between what the paper market says is available and what the physical market can actually deliver. And that mismatch is now visible in the Chinese premium. Let's connect this to the paper market. The COMEX in New York is where silver futures trade. It's where the price you see on financial websites gets set. And the COMEX operates on a fractional reserve model. They don't hold enough physical silver to deliver against every contract. They hold enough to deliver against the small percentage of contracts that actually stand for delivery. Most contracts are rolled or cash settled. The system works as long as everyone plays along. As long as most traders treat silver futures as a financial instrument rather than a claim on actual metal. But what happens when that assumption breaks? What happens when a meaningful percentage of contract holders say, no, I want the metal, not the cash equivalent? You get delivery stress, you get refiners rationing, you get mints declaring force majeure, you get premiums in Shanghai hitting $51 because the paper market can print contracts infinitely. The physical market cannot print metal, and when those two realities collide, the paper price doesn't matter anymore. What matters is whether you can actually get your hands on the product. And in China, you can't. Not at $29, not at $40. You're paying $80 and you're waiting in line. Now here's the part that should concern you. This isn't just a China problem. It's a warning of what happens everywhere once the illusion breaks. The Western paper markets are still pricing silver as if supply is abundant, as if inventories are deep, as if the system can deliver on demand. But inventory data tells a different story. COMEX registered silver, the portion available for immediate delivery, has been declining for 2 years. It's currently sitting near multi-decade lows. London vaults, which back the iShares Silver Trust and other ETFs, have seen outflows month after month. Retail premiums in the United States are running $4 to $6 over spot for basic products like American Silver Eagles. That's not normal. That's not a functioning market. That's a market where the price on the screen and the price of the product have started to drift apart. Let's play this forward. Imagine you're an industrial buyer in Europe. You need silver for a photovoltaic cell production. You see the price at $29. You put in an order, and your supplier says, sure, but delivery is 8 weeks out, and we're adding a $12 premium. You ask why. They tell you there's a shortage in Asia, and metal is being diverted. You don't care about Asia. You care about your production schedule. So you pay the premium. And then your competitor does the same. And then every industrial buyer in your sector does the same. Suddenly, the $30 paper price is irrelevant. Everyone is paying $42, $45, $50. Because that's what it costs to actually secure the metal. And the paper market? It keeps printing contracts at 30 because the paper market doesn't care about tightness. It cares about margin requirements and settlement rules. This is how decoupling happens. Not in one dramatic moment, but in a slow drift where the paper price becomes a polite fiction that fewer and fewer participants believe in. And once that belief breaks, once the market accepts that the screen price is just a reference point disconnected from physical reality, something dangerous happens. The contracts lose credibility. The ETFs face redemption pressure. And the holders of paper silver start asking a very simple question. If I can't actually get the metal at this price, why does this price exist? Here's what the Shanghai premium is really telling you. It's telling you that in the largest manufacturing economy on Earth, the financial system's price has already been rejected. It's been overridden by physical reality. And when physical reality overrides the financial system in one major market, the rest of the world doesn't get to pretend it's isolated forever. What's happening in Shanghai is a preview. It's showing you what price does when supply isn't there to meet it. And right now, supply isn't there. Let's talk about why supply isn't there. Silver isn't primarily a mined product. 70% of silver production is a byproduct of mining other metals. Zinc, lead, copper, gold. If those metals slow down, silver production slows down. And base metal mining has been underinvested for a decade. Permitting timelines are longer. Environmental opposition is stronger. Energy costs are higher. The easy deposits have been mined. What's left is lower grade, harder to extract, more expensive to refine. Meanwhile, demand is accelerating. Solar installations globally are running ahead of forecasts. Electric vehicles need more silver per unit than combustion engines. 5G infrastructure requires more conductive metal than 4G. AI data centers use silver-bearing components. You're looking at a demand curve that's bending upward while the supply curve is flattening. And the market is pricing this dynamic as if it's temporary. It's not temporary. The energy transition is not optional. The electrification of transport is not optional. The build-out of digital infrastructure is not optional. These are policy-driven, multi-decade commitments backed by trillions in government spending and private capital, and they all require more silver than the market has historically supplied. So either the price goes up enough to incent new supply and ration demand, or shortages become chronic. There's no third option. And right now, the paper market is pretending there's a third option. The Shanghai premium is the market's way of forcing that conversation. It's saying the $30 price isn't real. It can't clear the market. It can't call forth enough supply or destroy enough demand to balance the equation. So the real price, the price that actually moves metal, is adjusting. And it's adjusting violently. $51 over spot is not a normal adjustment. It's a dislocation that implies a systemic breakdown in the price-setting mechanism. Now, let's address the counter-argument. Some will say this premium is artificial, created by capital controls in China that prevent free flow of metal. And there's truth to that. China's capital account is not fully open. Moving large quantities of physical commodities in and out requires approvals. But that's been true for decades. Capital controls didn't suddenly appear last month. What changed is the intensity of demand meeting the reality of supply. The controls didn't create the shortage. They're just preventing the shortage from being papered over with financial engineering. In a fully open system, Western banks would lease silver from central banks or ETF inventories, ship it to Shanghai, pocket the premium, and flatten the spread. But there's a problem. The metal that's theoretically available isn't actually available. ETF inventories are held on behalf of shareholders. Central bank silver holdings are minimal compared to gold. Private stockpiles are in strong hands that aren't selling. So the arbitrage fails. The premium persists. And what you're left with is a market structure where the price in the West is set by contracts that don't require delivery, and the price in the East is set by actual users who need the physical product. And those two prices are now $51 apart. This is what a squeeze looks like before it's called a squeeze. It doesn't announce itself. It builds quietly in the shadows of the physical market while the paper market continues to print. And then one day, the paper market tries to deliver and realizes it can't. That's when the squeeze becomes visible. That's when premiums don't just rise, they spike vertically. That's when mints shut down public sales. That's when ETFs suspend redemptions. That's when the COMEX changes delivery rules to allow cash settlement instead of physical. And all of that has precedent. It happened in nickel in 2022. It happened in palladium in 2020. It happened in crude oil in 2020 when futures went negative. Markets that are assumed to be deep and liquid can seize when the gap between paper and physical closes violently. The thing about squeezes is they're binary. Either the system delivers and the premium collapses, or it can't deliver and the premium explodes. There's no middle ground. And right now, every indicator suggests the system is moving toward can't deliver. COMEX inventories are thin. Refinery capacity is maxed. Lead times are extending. And the largest consumer in the world is paying double the paper price. That's not a setup that resolves gently. Let's talk about what this means for the West. If the Shanghai premium holds, if it widens, if it starts showing up in other markets, London, New York, Zurich, then the paper price becomes untenable. You can't have a global commodity trading at $30 in futures and $80 in physical without one of those prices adjusting. And historically, it's the paper price that adjusts, not the physical. Because the physical price is real. It's what someone actually paid to take possession. The paper price is a derivative. It's a bet on the physical price. And when the two diverge, the derivative loses. Here's the uncomfortable truth. Most people own paper silver. They own shares in ETFs. They own futures contracts. They own mining stocks. And they assume that if silver goes to $100, their paper claims will reflect that move. But if the premium structure in Shanghai becomes the norm, if physical silver trades at a sustained premium to paper, then the paper claims are worth less than the metal they're supposed to represent. The ETF might say it holds 1,000 ounces, but if you try to redeem those shares for physical, you might find there's a delivery delay, a cash settlement option, or a premium you didn't expect. And at that point, your paper silver isn't silver. It's a claim on silver that may or may not convert at the price you thought. This is the risk nobody is pricing. The risk that the financial system's silver and the real world's silver are no longer the same thing. And once that perception takes hold, once traders and investors realize that paper and physical are not interchangeable, the entire structure of the market changes. Because value flows to the thing that's scarce, not the thing that's printed. And physical is scarce, paper is not. Now, let's bring this back to the title. Silver is already $80 in China, not in theory, not in some future scenario, right now, today. The premium shock you're seeing isn't speculative froth. It's a market telling you that the globally accepted price is fiction. It's a signal that somewhere in the chain between futures contracts and physical delivery, the system has broken. And the break is showing up first in the place that needs the metal most, the place that can't afford to wait, the place that's willing to pay whatever it takes to keep the factories running. The question you should be asking is not whether this premium will collapse. The question is whether this premium is coming to your market next. Because once the idea takes hold that paper silver is just a claim on metal that might not be there, once that idea moves from Shanghai to London to New York, the repricing won't be gradual. It will be violent. And by the time it's obvious to everyone, the metal will already be gone. Here's the uncomfortable reality. The silver market is smaller, thinner, and more fragile than almost any other commodity. It doesn't take a massive buyer to move it. It doesn't take a central bank pivot or a geopolitical crisis. All it takes is a realization that the price on the screen is not the price of the product. And that realization is happening right now in China. They're not paying $80 because they're dumb. They're paying $80 because that's what it costs to actually get the metal. And if you think the price stays contained in one country, you're betting on a system that's already showing cracks. This isn't a prediction. This is observation. The premium exists. The shortage exists. The divergence between paper and physical exists. What happens next is just math. Either supply increases dramatically, demand collapses, or price adjusts to clear the market. And given that supply takes years to bring online, demand is policy-driven and inflexible, and price is currently set by a paper market that doesn't require delivery, the path forward is obvious. The $80 price in Shanghai is not the outlier. The $30 price in New York is. Let me frame this differently. Imagine you're holding a futures contract that says you own silver at $29. And imagine someone offers you $80 cash right now to tear up that contract and walk away. You'd take it. Everyone would take it. Because 80 is higher than 29, and cash is easier than delivery. But now imagine you're holding physical silver. Someone offers you $80. Do you sell? Maybe. But what if you think the premium keeps widening? What if you think that 80 today becomes 100 tomorrow because the system is breaking and metal is the only thing that's real? Suddenly, 80 doesn't look so appealing. You hold. And when holders hold, supply tightens further. And when supply tightens, premiums widen. And when premiums widen, more people realize the paper price is meaningless. It's a feedback loop. And feedback loops in commodity markets don't resolve gently. The broader implication here goes beyond silver. It's about what happens when financial markets decouple from physical reality. We've been living in an era where prices are set by derivatives, by contracts that are cash settled, by systems that don't require actual delivery of the underlying asset. And that works fine as long as nobody asks for delivery. But the moment someone does, the moment physical settlement becomes the norm rather than the exception, the entire pricing mechanism breaks. Because the financial system can create infinite contracts, but it cannot create infinite commodities. And when that limit is hit, the contracts become worth less than the thing they represent. This is the lesson of Shanghai. The premium isn't telling you that Chinese buyers are overpaying. It's telling you that Western sellers are underpricing. It's telling you that the paper market has lost the ability to set the real price. And once a market loses that ability, once price discovery moves from exchanges to physical transactions, the transition is not smooth. It's chaotic, it's disorderly, and it's extremely profitable for anyone holding the actual asset. Here's what should concern the institutions, the banks, the ETFs, the exchanges. If the Shanghai premium becomes the norm, if physical silver consistently trades at multiples of the paper price, then the entire financial structure built on silver derivatives is at risk. The COMEX can't function if every contract stands for delivery. The ETFs can't function if every shareholder demands physical redemption. The system requires that most participants stay in paper. It requires that the metal stays in the vault while the claims circulate. But what happens when trust in that system erodes? What happens when investors decide that paper is just paper and metal is the only thing that counts? You get a run. Not a run on a bank, but a run on the commodity itself. Everyone trying to convert paper to physical at the same time. And the system doesn't have the metal to satisfy that conversion. So it does what it always does. It changes the rules, it suspends redemptions, it offers cash settlement. It redefines what delivery means. And when it does, the paper claims collapse in value because everyone realizes they were never actually backed one-to-one. They were fractional. They were probabilistic. They were based on the assumption that not everyone would ask for the metal at once. Shanghai just asked for the metal, and the system couldn't deliver at the stated price. So the price adjusted violently. And if you think that adjustment stays contained in one city, in one country, you're not paying attention to how commodity markets work. Arbitrage doesn't care about borders. If metal is 80 in Shanghai and 30 in New York, traders will try to buy in New York and sell in Shanghai. But they can't, because there's no metal to buy in New York at 30, not in size, not for delivery. So the arbitrage fails, and the prices stay disconnected. And eventually, the New York price has to rise to meet the Shanghai price, or the Shanghai price has to fall to meet New York. And given that Shanghai is the demand center, given that they need the metal and the West is just trading contracts, which price do you think adjusts? This is not complex. This is supply and demand at its most fundamental. When the thing people need becomes scarce, price rises until either more supply appears or demand is destroyed. And silver supply is inelastic. You can't just turn on a mine. You can't just refine faster. The metal comes out of the ground at the rate it comes out. And demand is also inelastic. You can't build a solar panel without silver. You can't make a circuit board work without it. So neither side bends easily, which means price is the only variable that can move. And it's moving in Shanghai, fast. Now let's talk about what this means for you, whoever you are, wherever you are. If you own paper silver, you need to understand that your claim is only as good as the system's ability to deliver. And that ability is now in question. If you own physical silver, you need to understand that the price you see on financial websites is not the price you'd get if you tried to sell. You'd get more, possibly a lot more, depending on where you are and who's buying. And if you own nothing, if you're just watching this from the sidelines, you need to understand that this is not a normal market dislocation. This is the early stage of a repricing event, the kind that happens when a commodity market realizes it's been mispriced for years and the correction happens all at once. The Shanghai premium is the canary. It's telling you that the paper system is fragile, that the physical market is tight, and that the gap between the two is widening. And when that gap gets wide enough, when it becomes undeniable, the financial system will be forced to acknowledge it. But by the time the acknowledgement comes, the move will be over. The metal will be locked up in strong hands. The premiums will be entrenched. And the people who waited for confirmation will be the ones paying $80, $90, $100, while the contracts on their screen still say 30. So here's the real question. Not whether silver is going higher, that's already decided by the math. The real question is whether you believe the paper price or the physical price. Because right now they're telling you two completely different stories. One says everything is fine, metal is abundant, and the system works. The other says the system is breaking, metal is scarce, and the price has to adjust. And Shanghai has already picked a side, The thing about markets is they don't move in straight lines. They move in dislocations. Long periods of stability followed by sudden, violent repricings. And those repricings don't wait for everyone to be ready. They happen when the last holder of physical loses faith in the paper price, when the last industrial buyer decides they'll pay whatever it takes, when the last arbitrage fails, and the market realizes the emperor has no clothes. And right now, in Shanghai, that realization has already happened. The premium is the proof. $80 is the price. Not because of speculation, not because of manipulation, but because that's what it costs to get the metal. And if you think the West is immune, if you think the paper markets here are somehow more robust, more liquid, more capable of delivering than the physical markets in China, you're making a very expensive assumption. Because the same dynamics are building here, the same inventory drawdowns, the same industrial demand growth, the same underinvestment in supply. The only difference is that the Western markets have more layers of financial abstraction, more derivatives, more ways to pretend the metal is there when it's not. But abstraction doesn't create metal. It just delays the moment when the shortage becomes undeniable. Shanghai removed the abstraction. They went straight to the physical market and asked for delivery. And the market said, sure, but it's going to cost you 80. That's not a negotiation. That's reality. And reality doesn't care about futures curves or analyst forecasts or central bank comfort. Reality is what happens when you try to take possession. And you find out the thing you thought was abundant is actually scarce. The premium shock in Shanghai is not an isolated event. It's a warning. It's the market telling you that the price you see is not the price that clears. It's the market telling you that paper and physical have started to diverge. And once that divergence begins, it accelerates. It's the market telling you that the system you thought was stable is actually brittle. And the brittleness is showing up first in the place that needs the metal most. And if you're paying attention, if you're listening to what the market is actually saying rather than what the analysts are telling you it should say, then you already know what comes next. The $80 price in China is not the peak, it's the floor. It's the new baseline for a market that's realized the globally accepted price is fiction. And once that realization spreads, once it moves from Shanghai to Singapore to Zurich to New York, the repricing won't be a $51 premium. It will be a complete reset of what silver is worth when you actually need to hold it, use it, and can't get it anywhere else. So here's where we are. A critical industrial metal, essential to the energy transition, is trading at two completely different prices, depending on whether you want a contract or the actual product. The gap between those prices is widening, not narrowing. The inventories backing the paper market are declining. The demand from industry is accelerating. And the largest consumer in the world is paying nearly triple the official price just to secure supply. That's not a market that's functioning. That's a market that's broken. And broken markets don't fix themselves gently. They reprice violently. And when they do, the people holding paper watch their claims evaporate, and the people holding metal watch their wealth multiply. The Shanghai premium is not asking you to speculate. It's asking you to observe. It's showing you what price does when the illusion breaks, when the contract and the commodity stop being interchangeable, when the system that promised delivery can't deliver. And the answer is clear. Price explodes. Not because of hype, not because of momentum, but because that's the only way to balance a market where supply is fixed and demand is relentless. You're watching it happen in real time. $80 in Shanghai, $30 on the screen, $51 of pure dislocation. And the dislocation is not resolving. It's widening, which means the paper price is wrong, the physical price is right, and the adjustment is coming. The only question is whether you're positioned for it or pretending it's not happening. The math is already locked in. The premium is the proof. And physics doesn't negotiate with futures contracts. Now, before we close, here's a question for you. And I want you to think carefully about this, because your answer will reveal whether you understand what's actually happening. If you could buy physical silver today at $30, knowing that it's already trading at 80 in the world's largest manufacturing economy, would you take that deal? And if your answer is yes, ask yourself why the people who actually need the metal, the ones running factories and building infrastructure, aren't taking that deal either. Because they can't. The metal isn't there at that price. Drop your answer in the comments. Tell me if you think this premium collapses or if you think it is coming to your market next.